Hello and welcome to Numera's March online briefing, Financial Warfare and Commodity Markets, a presentation on global commodity markets and the Russia-Ukraine war. I'm Matthew Lapointe, a business development associate here at Numera, and I'm joined today by Federico Filippini and Mathieu Wiener, two of our senior economists here at Numera. Using the Q&A feature, we encourage you to write any questions you may have for Federico and Mathieu, and we will try to address them at the end of the session. Also, note that later today, we will send you a copy of this slide deck as well as a recording of the webcast. With that being said, I'd like to pass it on to Federico and Mathieu to begin our presentation.
Thank you, Matt, and good morning to everyone joining us. So the way our briefing is structured today is that I'll be providing an overview of commodity markets since the outbreak of the Russia-Ukraine war, and I'll also be covering our pricing outlook and how we see demand and supply evolving over the coming year with a special focus on crude oil. Afterwards, our senior strategist Federico will be providing you with some investment recommendations that are tailored to this challenging macro environment. So the Russia-Ukraine war has obviously been the main factor driving commodity markets this year. As you can see on this chart, which shows you the World Geopolitical Risk Index over the past 100 years, the war has led to a very large spike in geopolitical risk, and also it has caused the largest and the broadest increase in commodity prices that we've seen for any armed conflict or any geopolitical event since World War II. So this is because, unlike previous conflicts, the Russia-Ukraine war actually involves countries that play a really important role in not just one specific commodity, but across all major types of commodities, so energy, metals, and agriculture. We can see this in this chart, which shows you the rise in prices by commodities so far this year on the vertical axis, and what we see is that changes in prices by commodity are directly tied to the share that Russia and Ukraine occupy in the global supply of each commodity, which is what is displayed here on the horizontal axis. So for instance, Russia and Ukraine account for about a quarter of the global exports of wheat, and the price of wheat has increased 40% so far this year. And this dynamic is true for a number of other materials, including nickel and also crude oil. Now, what we find in these sectors with exceptional price growth is that upon closer examination, the recent gains are mainly driven by speculation and concerns about supply. So as an example, our structural models for oil are showing us that it's actually currently trading at a pretty steep premium, as you can tell by this chart, of about $28 per barrel. And so this means that the price of oil is about $30 above the price that is supported by market fundamentals. Now, this large risk premium is primarily a reflection of trader speculation around the undeniable uncertainty surrounding oil supply, especially in the near term. Now, this is particularly important because Russia is actually the second largest producer of oil in the world. As you can see from this chart, which shows you in the large donut on the left, world production broken down by producing region in the world, what you see is that Russia is, after OPEC, which is one group, the second largest producing country in the world, and it accounts for 11% of global oil supply. And as you can see from the smaller donut that you see on the bottom, about half of this production is exported. Now, again, half of Russian oil exports go to the European Union, and this is important because as we speak, many Western buyers are actually refusing to purchase Russian oil, and the European Union is actually currently considering banning imports of Russian oil altogether. While at the same time, Russia is also demanding that countries start paying for its oil in rubles. So, of course, this situation has led to very significant market tightness, and it also creates a very large amount of uncertainty around the near-term trajectory for prices, with a lot of potential upside if purchases of Russian oil were to fall dramatically. Now, in the medium term, it's important to consider how much idled capacity is available elsewhere in other parts of the world. So this is particularly relevant because of the fact that at current oil prices, new supply is highly profitable in every single major oil producing region in the world. So a large amount of unused capacity in the world currently finds itself among core OPEC countries. So Saudi Arabia, Kuwait, and the UAE. As you can see from this chart, which compares their available capacity to their current level of production, there's currently about a 3.2 million barrel per day shortfall of oil that is available in OPEC, and presumably a large portion of this could, in the event that it's needed, be ramped up in the short term, so in the next 6 months or so. Now, another important region that could feasibly increase its oil supply noticeably in the medium term is the US. So in this chart, what we're looking at is the number of oil wells in the United States that are active in blue compared to the spot price for WTI oil in green. And what we see is that historically there has been a nearly 1-for-1 relationship between these two variables, but that this relationship has not really held ever since the price of oil has started recovering in mid-2020. Now, we do think that oil production in the US could increase in the medium term, but in the US, there is really a number of limiting factors. First of all, there's the fact that a lot of these oil companies have trouble finding workers, and there is also a lot of pressure coming from Wall Street to prioritize cash flow over production. But really what's clear is that at the current price of oil, it is far above either the break-even price for new wells, which is around $50 per barrel, and it is even further above the operating costs for existing wells of about $30. Now, beyond any increase in oil production or capacity in the medium term, another development that could also ease market tightness is actually China rebalancing the oil market by buying proportionally more Russian oil and proportionally less oil from other producing regions. Again, this would be a medium-term adjustment because the vast majority of existing Russian oil infrastructure is actually designed to deliver barrels west rather than east. So to reiterate, in the short term, supply concerns are very real and they contribute to high uncertainty around prices. However, if we look a bit further ahead, so a year out or so, we think that oil trader sentiment should normalize, and we also see production increasing, which should really ease a lot of the market tightness on the supply side. Now, on the demand side, we have to consider the effect that the war will have on global growth. So we think that the war is going to weigh on global growth through two main channels: higher inflation and lower sentiment. Now, higher food and fuel prices already directly depress consumer confidence, as you can see on this chart. And also beyond that, they also leave households with less discretionary income available for other purchases, which also decreases demand. Now, on top of this, this feeds into higher near-term inflation expectations, which means that central banks will be tightening monetary policy more aggressively than they previously expected that they would need to. So basically, this translates into three main factors that are weighing on the global demand outlook: higher energy prices, heightened geopolitical risk, and also central bank policy. So this chart that you see here was actually featured in the latest edition of our US macro strategist. And what it shows you is the results of a simulation exercise inputting these three shocks into our US growth model. And what we see is that in the medium term, these three factors will be lowering consumer spending by just under 1%. Now, the immediate impact this year mainly stems from higher oil prices, which you see in light green, and geopolitical risk, which you see in yellow. But over 2023 and 2024, it's really the lagged effect of higher real interest rates that will become the main drag on growth. But back to 2022, if we were to compare our pre-war forecasts from early February to our most recent projections, we arrive at the results that you see here. So we estimate that the war will be slowing global growth in 2022 by about 1%, or a bit more than $600 billion. Now, this slowdown in global demand will be especially noticeable in developed markets and in Europe in particular, because it is the region that is most exposed to and most dependent on the Russian economy. As you can see, we downgraded our GDP forecast for Europe by 2% because of the war, from about 4% in February to just under 2% now. Meanwhile, in emerging markets, the largest drag on growth will of course be on the EMEA region, since we expect the Russian economy to plummet about 15% in 2022. However, I think it's worth emphasizing that even with this downgrade to growth, we continue to think that the global economy will remain in what we call overheating mode, which means a macroeconomic regime of high inflation and still strong economic growth. Now, this chart that you see here was essentially capturing the effect of the war on our baseline scenarios, but at the same time, it's important to note that uncertainty has widened, and this is because downside risks have also increased. And the most important downside risk to our global outlook is the recent rise in COVID cases in China, which is seeing its most important COVID outbreak since the initial wave in early 2020. Now, China's zero COVID policy could be very disruptive, and just this week, Beijing announced a staggered two-stage lockdown for Shanghai. But really, what's important to note here is that a slowdown in China would not only reduce demand for raw materials, including oil, but it would also worsen existing supply chain bottlenecks. So it's definitely an important downside risk to monitor moving forward. Now, circling back to our outlook for commodities, here's our forecast for the global commodity index. I think it's important to note actually that about 60% or so of the index is actually accounted for by oil. And so this outlook for the broad index is of course skewed by the importance of oil. So 12 months out, we expect that Brent will be trading at about $95 a barrel. So while it represents a price decline versus current levels, it is still, all things considered, a pretty elevated price level. So essentially, to summarize, there is a tremendous amount of uncertainty around pricing in the near term, with potential sanctions creating some upside for prices. However, and this is important, 12 months out and beyond, we see an increase in global supply, a normalization in trader sentiment, and also a weaker growth outlook, translating into less tight commodity markets, meaning that prices should ease over the medium term. Now, my colleague Federico will be providing you with a number of investment recommendations to help you outperform in this challenging market environment. Federico?
Thank you, Mathieu, and good morning to everybody, and thank you for tuning in. So this has been a particularly challenging first quarter. The financial spillovers from the war follow the sizable corrections in equity, in particular in in growth equities, and the outlook for the rest of the year follow this same tune. Basically greatly influenced by the geopolitical earthquake that we are going through. Now, based on the fact that the broad commodity index should ease and settle at lower levels compared to the current spot prices, it is far more likely that the US economy will remain in a macro regime closer to overheating. That is, again, to repeat, we're going to face high inflation and high inflation risk, but still above trend growth and declining unemployment. Now, said that, we also have to acknowledge that there is an increasing probability that the economy will also turn to stagflation, meaning in that situation, there's going to be lower growth and rising unemployment. Now, what this chart shows is that alternatively, either we are facing an overheating or stagflation regime. The 60-40 portfolio typically underperforms over those two regimes. Now, let me go over quickly on this chart. So what we did was, starting in 1972, we identified the macro regime that the US economy was facing in each period in time. Then what we computed was the portfolio returns for the passive 60-40 portfolio weights. And what it's clear from this chart is that the passive portfolio really underperformed under these two regimes, which means that investors should try to diversify above and beyond stocks and bonds in these particular two regimes. Now, in the diversification process, investors should favor those assets in particular that have a low sensitivity to rising interest rates, and also that can potentially benefit from the rising inflation risk. Now, the rising interest rates have had a pervasive impact on equity valuations. Now, again, that impact was particularly strong for the more sensitive equities on multiplier expansions. Now, typically, there's been a very strong relationship between our measure for valuation, that is the 12-month forward P ratio. In this case, we are showing in blue that variable for the S&P 500, and the 10-year inflation linked bond yields that is shown in this picture in green. The rising long-term yields that basically reflected the expectation of the Fed tightening process trigger a sharp correction in valuations. Now, to be clear, what we are pushing is a neutral position on US equity, and what investors should try to do is try to diversify part of this equity risk that is related to the link on valuations. Now, over the last decades, the sharp correction in equity have triggered a portfolio shift toward bonds and cash. Now, the green line here shows the portfolio weights on bonds and cash for US investors. Shady areas represent those periods in which there's been a prolonged equity bear market. Now, what you can see is that during those periods in particular, bonds and cash holding has increased significantly, except for the current correction. So what has prevented investors from taking a larger exposure to safe assets is basically explained by the rising risk, rising inflation risk that damps the appeal on bonds, and not only nominal bonds, but also inflation index bonds, due to the risk that the rise on real rates that we just mentioned before. So again, investors should seek to diversify above and beyond stocks and bonds. What this chart shows is the relative performance of different alternatives in which the global investor could be interested for those two particular regimes that we identify as the most likely: the overheating that is shown in the vertical axis and the stagflation regime that is shown in the horizontal axis. Stocks are in green, bonds are in blue. What stands out in this chart are commodities. They tend to outperform both in overheating and stagflation regimes. And this explains why much of the interest and thus the speculation over the last couple of weeks has been concentrated around these assets. Yet, as Mathieu was discussing before, the war has fast forwarded much of this dynamic, in particular when it comes to those commodities more exposed to the conflict, that is crude oil, natural gas, nickel, and wheat prices in particular. These commodities surge well above the trend and well above fair values, again, as we discussed in the previous slides, basically sharply reducing any upside risk that we could see in the 12-month horizons. Now, part of that surge has been reversed in the last couple of days, mostly explained by the reduction in nickel prices. Those highly exposed Russia and Ukraine commodities are displayed here in the blue line. Now, the red line shows all the other commodities available. These other commodities, namely copper, gold, soybean, have not shown a disruptive behavior due to the war, and we think they remain very attractive in our view. Now, there's an interesting Latin American perspective also shown in this particular chart. So we can map both Colombia and Peru into this chart, meaning that Peru is being most exposed to the red line, to those commodities not significantly exposed to the war, and Colombia is mostly linked to the blue line. The fact that we are relatively bullish on commodity versus oil trade 12 months out fits very well into our overweight recommendation on Peru versus Colombian stocks. Now, we are also bullish on gold. This chart shows that gold historically has displayed a close relationship with real rates. The flight to quality effect usually tends to benefit both gold and bonds. Now, the increasing inflationary risk and the spike in geopolitical uncertainty open an opportunity for gold in this case. And this is in line with our recent call in which we recommend overweight on gold versus developed markets bonds that was published in January, basically due to the fact that gold remains a very effective inflation hedge, in particular when compared to bonds. We continue to maintain our overweight recommendation, basically as the work will further push the near-term inflation outlook upwards. Now, a distinctive feature of the current shock is the amplified impact that it has had on Europe. Growth in Europe has been significantly revised downwards, suggesting that the ECB is less likely to tighten monetary policy rates, which obviously should also soften the outlook for the euro. Now, in other parts of the world, in particular, unlike euro, central banks in Latin America lack credibility. So the lifting rates remains one of the only tools that they have at their disposal to anchor these inflation expectations. So what we're trying to push is that, for example, Brazil, that is very likely to respond to rising pricing pressures with further monetary policy, and also whose currency, the real, is also very likely to be benefited from the terms of trade gains, opens up a window of opportunity in which investors should aim to take advantage of the very significant carry trade opportunities in the short term. Now, going back to our premise, in which investors should favor those assets less sensitive to rising interest rates, and again, that can potentially benefit from the increasing inflation risk. Now, material sectors stand out across the equity space. Materials are a natural inflation hedge, in particular versus other defensive tilt sectors such as banking and utilities, which are also those other sectors that we are recommending, but not as strongly as our materials call that we published in February before the outbreak of the war. Now, we have to consider that, in particular, the EM materials stocks are not immune to the FX risk, basically given that there is a very high probability that the US will strengthen against emerging market currency as the commodity prices soften in the medium term, which is likely to weaken some of the upside for unhedged US investment. Finally, tactical positions on petro assets and petro currencies in particular, we think remain attractive over short horizons. In particular, the loonie is such an example. And let me take now a non-Canadian investor perspective. And from that perspective, the rising oil prices have lifted the loonie despite the flight to quality effects and the obviously geopolitical uncertainty. Now, given that Canada is a big resource exporter, high commodity prices support the terms of trade and also provide further upside for the Canadian dollar in the near term. In particular, also, if we think as what is our base scenario, in which the Bank of Canada will follow the path of high rates in the same way as the Federal Reserve. Now, to conclude, this table sums up some of the recommendations that we published over the last weeks in our reports and that we discussed today. The inflation risk and rising rates supports our overweight recommendation on gold versus developed market bonds. The higher exposure to China credit supply, stimulus and the low Russian exposure makes materials a natural hedge to the key shocks that we discussed. The historical pattern supports the commodity overweight during overheating and stagflation regimes. However, energy commodities have already fast forward much of the dynamic, reducing their upside risk. For this reason, we push an overweight call on non-energy commodities. Related to this, the relative upside of copper versus oil supports our relative call for Peru versus Colombian stocks. There is also the recommendation on the interest rate differentials, basically supporting the current trade on Brazil, leverage on the euro. And there is one final recommendation for from a non-Canadian investor perspective. We still see potential gains on the Canadian dollar as a tactical recommendation over short horizons. Now I turn back to Matt for your questions.
All right, well, thank you very much, Federico. So as Federico mentioned, we're now going to move on to the Q&A portion of the presentation. So we do have a couple of questions from the audience. So the first one we got was, do you expect the recent spike in oil prices will make the Fed hike rates faster?
Right, so regarding the Fed, I mean, their communication has definitely grown increasingly hawkish in recent weeks. I mean, just at the last FOMC meeting where they hiked rates by 25 basis points 2 weeks ago, they clearly signaled that a much more aggressive path for rate hikes moving forward. And since then, even in public appearances, Fed officials have also said that jumbo rate hikes of even 50 basis points were not out of the question. So is this because of the recent gains in commodity prices? Well, I mean, it certainly plays a role, since higher oil prices definitely feed directly into rising inflation expectations. And of course, with the Fed now saying that it is committed to long-term price stability, we certainly see a more aggressive Fed than what we expected a few months ago. And now, regarding what impact this could have on markets, we think that given the fact that the Fed has been very clear on the direction of monetary policy moving forward, we estimate and we model that really most of this impact has already been priced in to equity markets. And if you would like to read more about this argument in detail, I would encourage you to reach out to us so that we can pass on a copy of our most recent US strategy report.
Perfect. And then we do have another question as well. So the other question we received was, clearly you have a bearish view on oil in the medium term. Do you recommend a short position on oil moving forward?
Matt, let me take that one. So we have provided several arguments for which basically the demand and supply supports our view or bearish view on commodities. However, in order to understand where there are opportunities or which particular opportunity is the most relevant to trade this idea, the relevant question is what is priced in the markets already. Now, 12-month futures are currently trading around $20 a barrel, which means that the market is probably thinking that supply will respond more aggressively, or that the recession risks are higher than what we have priced, or either that the USD will strengthen beyond our expectations. Now, either way, this makes taking short position using put options extremely expensive, in particular due to the high volatility that is also priced in this market. Yet, we think that there are several alternatives in the derivative space from which investors can profit from our different view relative to the market. I invite any interested client to discuss this and any other recommendation with me on the phone. So please reach out either to me or to Matt. Later today, we try to schedule a call.
All right, well, thank you for that answer. And that's all the time we have for today. Thank you for tuning into this month's online briefing. As mentioned at the beginning of the session, we have a copy of the slide deck we will share with you later today. Thank you again for your time, and we hope to see you at our next online briefing next month. Have a great day.